And this is where it all ultimately comes home, which is what deals mean for the executives that oversee them. And so we're really pleased to have Andrew Douglas, who's a shareholder and partner at Polsinelli, whose expertise is really in the structuring of executive compensation, looking at the tax and stock option related consideration, because ultimately, when these deals happen, there's usually an impact on you individually. So Andrew's going to give us a walk through some of the key issues that you should be thinking about, because ultimately, as you're putting these deals together, it's not bad to think about yourself a little bit as well. So Andrew, come on up. And
just a little bit about our firm. We're an Am Law 100 firm, 750 lawyers. Plus, we have 19 different offices and key areas of practice: healthcare, corporate transactions, litigation, real estate, and what I do, employee benefits and executive compensation. Two purposes of today's presentation. One is to talk about shareholder considerations. When I was talking with the transaction advisors folks, they said we should have retitled this, "What's in it for me?" And that's really the approach that I'd like you guys to take, is we're talking shareholder here really in a sort of individual sense, the individual shareholder / executive, or just shareholder generally. The second thing is to remind you periodically how much time we have left before the happy hour starts, which is right back over there. So hopefully we can keep you guys entertained and attentive while we talk for the next half an hour or so. A little bit more about me. I used to work as a pension actuary. Anybody know what an actuary is? Worked for consulting firms and insurance firms. I used to work for Ernst & Young as a pension actuary, so I've spent most of my professional life in the midst of actuaries, accountants, and ERISA lawyers. So I am not the most interesting guy in the world, far from it, but hopefully we'll be able to entertain you for a little while here today. Let's talk about what we're going to really focus on today. We're going to talk about some typical practices that we see on the exec comp and employee benefit side for middle market companies. To me, middle market companies are just the most interesting of all, because you're big enough to really warrant having good advice, good advisors, good legal counseling, because you're battling the big boys for talent. You're trying to attract people, trying to hold on to people, and yet because of your ownership, particularly if you're privately held or PE held, you have a certain amount of control, so you can actually get stuff done. You don't have to worry about shareholders showing up with their pitchforks saying, why are you giving this exec comp package, or why are you being so generous? So you actually have a lot more flexibility and really control over how you reward your executives. We're going to talk a little bit about how we structure deals on the exec comp and employee benefit side, sell side and buy side considerations, and then time permitting, we'll talk about a couple of recent case studies that I've been involved with, which we'll talk about companies that can be had for a very reasonable multiple of EBITDA. So talk to me after today's presentation if you're looking to buy. Just the usual thing that we see in the middle market companies. I mean, you guys do the same things that our large clients do, frankly. You enter into employment agreements, you have restrictive covenants, all the other usual things. In my view, really, your exec comp philosophy really kind of depends on where you are in your overall life cycle. So if you're just starting out, you might not need anything more than a couple of offer letters and a non-disclosure agreement. But obviously, as the business matures, you really want to protect yourself and sort of formalize your key employment relationships through separate agreements and the other things that we're going to talk about. Restrictive covenants to me are something that middle market companies, in my opinion, often overlook and can be very tactical. For example, if you're dealing with an executive who's now reached a certain level of importance, you certainly want to have the ability to have a non-compete, non-solicit, non-disparagement provisions, whatever you may need to protect the business and the special activities they may be involved with. But restrictive covenants themselves can often solve tax issues. And you might think, well, how is that possible? Well, right now I'm helping a client that's involved in a sale. They're selling to a buyer. It's a change of control under the golden parachute rules, which if you've ever been down that path, those rules are very, very complicated to deal with. But you're actually allowed under the golden parachute rules to value restrictive covenants to solve the golden parachute excise tax. It's a way to reduce your excise tax exposure for the individual executive, and you can also ensure that deduction for the company. So again, that's an example that, in my opinion, is often overlooked, is the tactical use of restrictive covenants as you might be gearing up for an eventual corporate transaction. Performance incentive bonuses, I think we all know what that means. Obviously, as the business matures, you'll want to have the appropriate weight between cash and equity. We'll talk about that here in a second. Retention packages, as the representative from Huron was just talking about, those can be very tactical leading up to a deal or as part of a deal to hold on to your best talent. change of control agreements, and special transaction agreements. We see those quite a bit, severance agreements. The last item is something I think often gets overlooked as well. Perks and other non-cash benefits. To me, those are just as important. I was involved with a situation a couple of months ago where we got to the 5-yard line with an executive trying to hire someone new, and the executive said, well, do you have a telecommuting policy? And the company didn't have any type of formal policy or anything really in writing to pass along, and they were able to get the deal done. But it was an example where they hadn't really thought about sort of the additional non-cash benefits that really are important to people to bring that talent on board and to hold on to them. I think once you sort of figure out kind of where you are in your life cycle, I think the first question you're going to want to answer, frankly, in my opinion, the most important question is how much of that total comp package you're going to put into equity or equity-based awards. And the reason why I want you guys to focus on that is because it tends to sort of drive the rest of the comp package. So when we say equity-based awards, I'm using it quite broadly. I mean, options, restricted shares, phantom or SARs, but also if you have an LLC entity, you might be dealing with a membership interest transfer or some other type of ownership or voting interest transfer. You certainly want to have all those options on the table. Vesting, I think vesting tends to get missed a lot too. People tend to look at vesting being sort of a linear, time-based, kind of simple approach and never think about the design control that you have over setting up option grants or equity grants or whatever. You really can control the manner of vesting. And I would say that in recent years at least, there's been sort of a skew away from the sort of traditional time-based vesting to more of a performance-based approach. Again, if you're really talking to your top talent, you really want those folks focused on milestones, metrics that are not just based upon staying in the chair for 4 years and getting full vesting. So it's just something to consider that you do have design control over that as a general matter. The other thing to consider are the triggering events that might lead up to a corporate transaction, to a change of control or heading to IPO or whatever. You definitely want to give some thought ahead of time to what types of events are going to trigger acceleration of vesting and make sure you've got the appropriate balance there. I would say on that particular point, if you've probably heard the parlance single trigger versus double trigger vesting. So single trigger is just the occurrence of the event itself that triggers vesting. Double trigger is usually the occurrence of the event plus a subsequent qualifying termination of employment. That tends to be the more common approach, the double trigger approach. And I think if you're gearing up toward like an IPO, you definitely want to do things that are more common in the publicly traded world at least, which would definitely be a double trigger approach. The other thing that gets missed, in my opinion, is other restrictions. You can have a holding period if you'd like. I mean, it makes sense when you're just starting off to have the appropriate holding period requirement for your executives so they can't sell shares or otherwise get out of an ownership requirement that you may have through share ownership. Other restrictions can also apply. Again, you have a lot of design flexibility. So I think once you kind of get to that point and you sort of back into the total comp package, often we see companies in the middle market that don't have the right benchmarking or don't have a really robust benchmarking approach. And I think there's two bases for wanting to do that. One is obviously to stay competitive. I mean, there's information out there that you want to make sure that your executives are being rewarded correctly and that they're being paid fairly compared to peers. The other is just to make sure that it's just kind of working for you. I mean, obviously, you can't just set it and forget about it. I think, as the business changes over time, you're going to want your exec comp and your benefit philosophy to change over time as well. Obviously, peer data is important. If you're closely held or privately held, you may have a hard time coming up with peer data, but you can actually look at companies that have gone public in recent years. You can see the history of their stock grants or their compensation philosophy that's available in SEC filings. So there is information out there. It's just a question of which information is the appropriate benchmarking or peer data for you. So this kind of leads to the sell side. And again, this is very, very simplified in terms of how we advise clients. But essentially this first point, the previous panel was talking about the importance of strategy. And I really think, on the sell side, you've sort of turned the business around or you've got the business in good shape to be sold. You've put all this time into it. You've negotiated with the buyer. All the things that we've talked about during the conference today kind of come together. I think you really want to have some appreciation for your philosophy towards, how you're rewarding your executive, both leading up to the deal and then at the deal itself. Usually when I'm advising clients, I tend to be kind of mechanical about, having this discussion. Normally, if it's like a morning meeting, I'll say, let me buy some donuts. We'll come over, we'll talk for an hour. It'll be non-billable, and we'll just like sit in a room and come up with a few guiding principles. In the afternoon, you might have a happy hour or something like that. But essentially, the idea is you want a captive audience and really be free to express what the company may be doing from a exec comp philosophy standpoint. I think that's very, very critical because that really drives the development of strategy and then the implementation of that strategy. Understand use of equity-based awards. Again, this is very important. We talked about earlier that equity-based awards tend to be kind of where the excitement is. Certainly coming out of the market meltdowns of the last 10 or 15 years, and particularly the most recent one of 2008 and 2009, I think there was sort of a skew away from stock options, but stock options, believe me, are now back in vogue quite strongly, where you have executives that are more willing to have option or stock-based awards forming a bigger and bigger part of their compensation. So, I think there's greater use or greater appetite for companies, particularly if you're in a cash flow situation where you don't want to commit yourself to making bigger and bigger bonuses or cash payments. You really want to have more flexibility to use equity-based, and I think that's certainly the environment right now. Continuing assessments, we talked about this earlier, so competitiveness and overall peer benchmarking. So those are the three principles that we tend to advise, and I realize it's quite broad, but we'll see some examples when we get to the the case studies at the end, where I'm hoping we can spend most of our time. Okay, so on the buy side, so you're a buyer, you've lined up your financing, you've figured out how the deal is going to really take shape. I think you're going to go through the normal diligence process and kind of figure out, well, what are they doing now? What's the seller or the target company doing now? What's my ability to make changes going forward? I got to tell you, on the sell side, the biggest mistake I see is sort of legacy type of thinking, where you just sort of continue on doing what the seller did. And that may make sense in some situations, but that type of thinking, I think, leads to bad outcomes. And frankly, when you're negotiating a deal, your leverage over seller's employees and the seller themselves is never going to be any greater, frankly, to create sort of the employee change or the alignment that you're going to need going forward. So if you're a PE investor and you're coming in and you want to operate the business, work it into a larger portfolio, or operate the business in a different way, you're obviously going to want to determine what flexibility you have to make change. Going forward, obviously, as new grants come out, whether they're bonuses or whatever, and we'll talk about some examples here in a second, but you want to change basically all the performance goals, or at least tweak the performance goals as may be necessary to align with the business model going forward. Obviously, you may not know as a buyer, you may not know what the end game is for the business. I mean, you may have just sort of an idea that you want to work it into your portfolio, or make it part of a larger business, or whatever the reason may be. But you want to keep one eye open for what flexibility you might need down the road. So if you don't have an end game in mind, you might say, well, we don't want to commit to option grants with a 10-year term if we know we're going to terminate or we're going to sell the business within the next 3 or 4 years. You want to align essentially all the components of your exec comp program to align with what end game or what possible end game events you may have, IPO or rounds of financing or whatever the payday may be. Again, that'll help you, again, maximize the value of the business. So these considerations here, in my opinion, are critically important. I can't tell you that, how many times we've seen in deals where we do diligence and we realize that the company, the selling company, really doesn't quite have any type of unified approach to how they do grants, and it really does detract from the value. So in my opinion, exec comp, when it's working well, the programs and policies when they're working well, tend to be good for buyers and sellers, and they obviously can be good for the individual employees. Okay, so this is where I want to spend most of our time today. These are situations that we've had over the last, year or two, and I just pulled these couple of examples. I could probably come up with some more, but I think these examples kind of illustrate some of the principles. And by the way, please feel free to ask questions if anything, you want me to clarify anything or add to anything. But this is an example of a client that was a privately held national wholesale company. Actually had it was a family-owned company with I think maybe 10 or 12 family members owning different interests. The company for many years had suffered technologically. They had never sort of kept up with their competitors, and they had let the business sort of get away from them. And the other thing is that there was not really any succession planning. So they had the second generation that wasn't really kind of stepping up and showing any interest in the business. So the current owners, which are mainly in their 40s and early 50s, were kind of looking at it, well, what do we really do with this? What do we do with this business? What's our end game, perhaps? And so they knew they wanted to sell in a few years, again, because they didn't have a next generation coming up. So what they did is they took stock of their people resources, and they realized that in addition to the CEO and the CFO and the typical senior level folks, they actually had 3 different operational executives who were driving different parts of their business, their distribution, their sales, some other operational aspects. And the real impetus for them coming to me was that they had just lost one of their folks. They had just lost one of those senior operational folks, and they wanted to hold on to the other 2 because they knew that they were going to be critical to perfecting this turnaround that they were envisioning, and then adding to the growth and success, and then obviously positioning the company to be sold down the road. The company had significant concerns, again, with competitors that were coming in and poaching away the employees. So essentially for them, again, this was the client that I basically showed up with a case of 12-pack of beer and some donuts on a Saturday afternoon, and we watched college football, and by the end of the first half, we had pretty much our game plan in place. And this was where they had said, well, we don't want to turn over or transfer a lot of the stock ownership to the executives because we don't want to lose control. So they came up with basically a 3-part approach, a stock-based approach where, through an omnibus equity plan that we helped them draft, they were going to award or make awards to these executives up to varying percents, I think up to like 3 or 5% in total. But the total amount of their ownership, at least through they were willing to award, was no more than I think 20 or 25%. So they still wanted to have complete or mostly entire control over the business from a voting or a ownership interest standpoint, but they were willing to give a little bit of the stock-based ownership to their executives. The second thing they did was put in place retention agreements, especially with the operational executives, the folks who were driving the turnaround, the operational and the distribution side. 3-year retention agreements with milestone dates along the way, so you have like a 1-year date where they get a certain amount of the bonus, the second year where they get another part, and then a final amount. So they were trying to align over a 3-year period. And then the final thing is they launched a formal cash incentive program, and they had never done this before. They had never put this in place. But essentially their cash incentive program offered these folks much greater bonus opportunities than they had ever seen before. And so the cash incentives were predicated upon very specific metrics that were making sense for their turnaround, their business at large. 50 or 100%, I can't remember exactly, but range between 50 to 100% of the base comp as a bonus. So that was something that the executives obviously latched onto. This company now has actually turned around and completed its sort of reorganizational process. And what's happened is that the family generation that was now not expressing any interest at all in taking over the business, all of a sudden they're very interested. So the business has turned around. So that's what I mean is these types of strategies, I think, can create all sorts of different outcomes. So now this business has the ability to consider succession planning to that next generation, or they also have options to consider going IPO or selling or whatever. So the usual range of M&A and corporate transaction outcomes as well. So obviously, that's an example of where proactive strategy coming together, properly implemented, can really create good outcomes and flexibility for the company on the back end. The second case study is a manufacturing company that's currently owned by PE investors. It's a little bit kind of a strange ownership structure, in terms of the mix, but the individual investors and the funds don't agree on offering equity-based awards as being an optimal approach to retaining and motivating the senior executives. We see that quite often in practice too, that you're never really sure how much equity, if you're going to go down that route, how much to give. Here, the investors actually want to hold on to all the equity ownership, but obviously they have a very specific plan in mind for the business itself. So this is an example, I think, of really the magic being in trying to mimic stock performance over a period of time, and then to align the executives with the appropriate incentives to create the change in metrics or the change in business goals, so that the investors, again, can position the company for eventual sale. I think that's really where they're heading, at least as of now. So they had specific performance goals that they wanted to put on their, targeting towards an eventual IPO or other corporate transaction or liquidity event. They had good cash flow. So, all of these constraints, once diagnosed, really lead to a conclusion that, maybe equity-based approaches are probably not appropriate. However, they could certainly do phantom awards or restricted unit awards in combination with a short-term incentive and a long-term incentive program. So this is an example where the bonus programs drive the outcome, And we design, or help them design, a short-term incentive program in combination with their comp consultant and their other outside advisors. But basically, short-term goals were essentially feeding into the long-term goals. The short-term goal was a 1-year performance cycle. The long-term goal is 3-year performance cycle. So this is where the two taken together really end up with a nice outcome for the individual. And this is also a situation where they are very happy with their current approach. And again, giving them the flexibility to look down the road to hopefully position the company for whatever end game they might have, whether it's IPO or something else. Again, I think these are really good case studies, that, again, we've seen recently. Obviously, I'm sure the audience probably has, other examples that they've seen where exec comp and employee benefits really can drive the deal. But that's how I tend to look at employee benefits, and I think these case studies are good examples that, really they can really be used up front to drive outcomes. I think a lot of times, being an employee benefits lawyer, sometimes we're brought in at the very end where we're presented a term sheet that's already been agreed to. And it's usually a situation where they've already put it to the executive and the executive is aligned to it, and we're being asked to draft the employment agreement or the retention agreement or whatever the exec comp agreement is. And we realize that it's not an optimal approach, or even worse, it has like a tax defect that we have to then go back to the executive and say, well, we didn't really mean this, we actually meant something else. I can assure you that is not a fun conversation when you're talking about hundreds of thousands of dollars or millions of dollars of exec comp or employee benefit package on the table, especially if you're just now starting off a relationship with that executive that you're depending on, to drive the business. So, if I were going to say one thing, or maybe two things about, the use of benefits advisors or outside advisors to help you on these types of issues, upfront counseling where you're sitting there and diagnosing constraints on the whatever issue you're going to be dealing with, but also developing that upfront strategy, because again, that is absolutely critical. And I'm hoping that's a common theme of all the presentations today, that upfront counseling, whether it's an hour here, an hour there, that's money and time well spent, in my opinion, because again, it diagnoses what the optimal outcome should be. The second approach is just really, again, putting the benefits and the exec comp policies up front. I mean, don't be afraid to be creative about using them affirmatively. I think a lot of times benefits kind of trail the discussions, frankly, and that they're not properly utilized or utilized to their full potential. But certainly, seeing examples today, I think there was an ESOP session earlier that probably talked about the ability to use an ESOP to drive a deal, but it applies broader. I mean, you can use all sorts of different arrangements that we've already talked about to also create the change, and whether you're on the buy or the sell side. But essentially, it's definitely possible to have exec comp and benefit policies and programs create good outcomes for everybody. And like I said earlier, to write those big checks and let everybody get what they want out of the deal. We have about 10 minutes or so before the happy hour, or 8 minutes or so before the happy hour. But I wanted to save some time for questions and see if you guys had any comments or questions or anything specific you'd like to talk about.
Hi. Interesting presentation, actually, and something that I can relate with from a recent experience we did on a transaction. The expectation game with executives from a selling company who are asked to stay for a year or two, and even for that matter, their management team, in terms of compensation, can differ significantly from what your expectations are. For example, even from a bonus payout standpoint, they might have expectations that their max bonus is paid every year. What we found is that following year, that's what they wanted, and that wasn't consistent with our organization at all. So we had a huge gap there amongst in other areas. So even though the deal was clear on paper, it wasn't clear to the seller how it would be handled post-close. So I guess my question is, how do you mitigate that?
Yeah, what typically happens there is the deal document will have some type of provision that says that the buyer will offer comparable pay or benefits, and really you don't reach that level of detail, so that the expectations of the really important executives and frankly the entire employee population are realized. Every deal sort of takes its own shape on that point, but obviously I think the better you know the employees that you're trying to onboard, whether that's through discussions or whatever, I think you'll identify sort of that gap analysis where your programs, because they're going to be operated under a different philosophy, could still be tailored to provide something that's comparable or maybe even better than what the selling entity is. So again, I tend to be mechanical about these things. I'm not one of those benefits lawyers that likes to shoot down deals because there's some remote tax issue that could come up. I like to see deals made. So I'd like to, basically think that the more conversations or the more upfront, discussions that you have, whether it's on your side or perhaps reaching out to the other side if appropriate, I think you're going to diagnose those issues and hopefully come up with an approach that will be palatable. Because obviously, as I said earlier, you don't want to end up from day one off on bad terms because you're depending on those folks to really, drive the business going forward. Any other questions? Yeah.
What are you seeing as best practices in creating earn-out provisions in deals?
Yeah, I mean, earn-out is actually, we see that a lot in deals. I mean, obviously the business aspects of how the earn-out works are kind of left up to the corporate folks or the deal folks. But in terms of an exec comp approach, we certainly see lots of strategies where a certain amount is held back and then paid out over time. And the good news is that the tax rules actually allow you to do that without blowing, any sort of, strange or penalty taxes under, 409 Cap A of the tax code. So actually you're allowed to structure a payout, like if you're buying shares of a target company, you can buy that executive shares and then structure a piece of it as an earn-out. And as long as the earn-out is paid, I think within a 5-year period after the date of the closing of the transaction, you're still okay from a 409 Cap A standpoint. I think that's common. I mean, it's certainly something you could also, depending on, again, how the deal takes shape, but it's certainly the flexibility you do have to sort of hold that back and then create the appropriate, alignment through, those trailing payments that are still yet to be made. Yeah. Yep.
Do you find that you need to change your strategy some depending on the state that the employee's in? For instance, California being a very litigious state.
Yeah, well, that's a good question. I think there are strategies on the employment side for sure that are very much state specific. So for example, the enforceability of non-compete provisions often vary tremendously from state to state. So when we're working with Labor and Employment Council, we'll identify states that have very restrictive rules because the company that's making the purchase may just expect that California executive to immediately sign on to the non-compete, not recognizing that the non-compete may just be completely gutted from the very beginning. So, obviously I think there is a state-specific analysis to be had, but I think it's more probably on the employment side as opposed to the tax and benefit side. Yeah, absolutely. Yeah, the restrictive covenants definitely have a state, It's always possible, especially if you are a buyer and you don't really have already operations. If you're buying something remote and you're trying to work those employees into your larger employee population, there's going to be harmonization issues to, morale issues perhaps to worry about. But yeah, definitely state-specific issues do come up in the context of M&A deals. Any other questions or comments? If anyone has any questions about anything that we've talked about today, I'll be around. I'm happy to talk further. And obviously, I appreciate all your time, and happy hour is only a couple minutes away.